Okay, let's carry on with the market conversations, and we have Sanjay Parekh, founder and CIO at Sohum Asset Advisors, joining in. Sanjay, great to have you with us. Pleasure to have you this afternoon on the show. Hi. So, two-part question. First of all, is the correction over? And if yes, then what do we expect from here? This market has always had V-shaped recovery since COVID, but is it going to be a little more boring and difficult this time?
No. So, you know that we, our fund has a mandate wherein it's a large cap oriented fund. So we take a very active view on Nifty and do communicate. And it's always humbling because at 23,000, we really felt that the risk return is very favorable. And then we saw 22,000, almost 22,200. But, we really at that point, and we sent you the note as well, that we really felt that, the risk return was extremely favorable. If you take earnings yield versus debt yield at that point, earnings yield was 5.3%, which is reverse of price earning on FY26. The 10-year yield was 6.7. So at 1.2% gap, typically you tend to outperform, and there is a meaningful upside over last 10, 15 years, barring COVID or 2008. The another thing is, of course, clear price earning, historical price earning. If you see, we were lower than the averages of the last 5 years. And then if you also take ROE and growth of Nifty, because globally people look at India as a stock for allocation. A lot of global funds look at the simple ROE growth model. So if Nifty has an ROE on 26 at 15.6%, and even at 10% growth, it was implying 3.35 times price to book, which was coming at 25,300, 20,500 on FY26. So at 22,500 was really, really comfortable, and the risk was extremely favorable. And we've gone on record saying that next year earnings of 1,200, and then in 26, 27 around 1,350. And obviously when growth is less, there's a debate whether India should trade at 18 or 20 times, but we genuinely believe that if growth recovers, we can go back to 20 times. And that would mean from here as well, 15, 16% return in the next 15 to 18 months. So I think, you can never say you can't react another 2, 3, 4%. And you have global risk as well of Trump-related policies. But I think every fall, one can slowly start accumulating. Having said that, this year will be a low of slow recovery of earnings growth. I don't expect Q4 also to be great. It will be a little better maybe, but bottom up, I don't see a big earnings surprise in Q4.
Okay. By the way, just want to point out, guys, that the market fall has simply continued on. Now it's a near 200-point fall in the Nifty. We've had in the last about 15-20 minutes, it's accentuated a little bit. A lot of the large cap economy-facing stocks have come in for additional selling pressure. There you go. That's the heat map. So it's a big red move across the board. And if you look at individual names, Adani Enterprises, Power Grid, L&T, BEL, NTPC, so a lot of these economy-facing stocks coming under pressure. So that's a red screen for now.
Sanjay, your whole M&M in your portfolio, you like autos on the whole, and one of the stocks that, that's a part of your portfolio is M&M. Now there is chatter about how M&M is going out there to and possibly consider acquiring SML Isuzu. If that happens, what are your thoughts on this M&A?
Yeah, actually, for the market cap of M&M, it's a small acquisition. So we actually feel it's almost like a non-event. It's a small acquisition which will be an add-on to their portfolio. I mean, we're not negative or, we're not saying that they have moved away from the capital allocation policy. I think such acquisitions, even if it's a bit smaller, could be strategic. So we are not negative. I don't think anyway, it's a very small acquisition, So sometimes that materiality matters as well, So it's not digressing that they're getting into areas which are not related. So we are not perturbed by this.
Hi Sanjay, good afternoon. Good to see you again. First of all, good on that call on Vedanta. The last time we chatted, the markets were in disarray, and you said no. We believe that in fact, that you and your entire team believes that you'll make money out here, and you'll stuck to that call, and the stock has done quite well from there. So good on you all. It appears that demerger date as well is in the offering. Now, if you look at your
portfolio, you all covered it so well. I mean, the last interview really helped to get confidence from us as well.
Right.
So it was a very, very well-covered interview and really compliment to you and team.
Okay, all right. Well, Shireen did that one, with some support. So that was good. And, actually, we had presented that piece, a special situation, I think around 420, 430 rupees odd. So from there as well, it seems Vedanta has got some support. That said, if I look at your portfolio construct, it appears the NBFCs, that's something that you like, because even in comparison with the benchmark, you all seem to be overweight. You'll have a lot of stocks in there. Bajaj Finance is the notable one out there. India Shelter Finance Corporation. Give us the rationale. The rate cuts could be one. You believe the worst of asset quality is behind, and you think growth will be good. Tell us more.
Yeah, so, the thesis was this, and I mean, Bajaj Finance, we've been holding for 3 years. So the first 1.5 years, it did not perform. And then we further topped up after the recent meet. And there's very, very clear longevity of growth was there. For the growth, the valuations were reasonable. The leadership is top class, and now the continuity of the leadership. So it was absolutely, we topped up at that point of time. The two housing finance companies, India Shelter, one is in the lower end of the affordable housing. The other one is around mid-size at 25-30 lakhs, which is Canfin, which is a recent entrant that we have. Shriram Finance now been holding for 1 year plus. We again felt then, it was really well placed, and we've been holding. It's done quite well for us. It was before it got included in Nifty. So, and now I think it could pause or consolidate for a while, but structurally for the ROE, and they've maintained the asset quality. They have now not only a vehicle finance book, but also, the lower end strata where they cater to the erstwhile SCUF book. So ROEs are good. Price to book is not that cheap now. So we like them from a structural piece. So these are and then of course we have small weight in Angel, which I think in the next 2 quarters could be weak quarters. But overall, our point was not because of the rate cuts and they benefited. I think some of these are structural positive where they can grow irrelevant of the interest rate cycles. And they've done quite well on asset quality. The housing finance is pretty insulated on the asset quality side. And both of them were Canfin had some recent issues, but it was available really cheap at 1.2, 1.3 times. The India Shelter was clearly bought for the longevity of growth, and they've grown very, very well. Very good pedigree of promoters, and hence we own them.
Sanjay, out of time, but thank you very much for joining in. Great conversation as always. We'll slip into